Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Target came out with earnings today, and the market does not like what they see. The stock is down about 13% as I'm recording. But I think this is a massive overreaction to Target, which I think is doing a lot of things right in commerce right now. Let's get into what the numbers look like. Here you can see just a stock chart for the day as I'm recording. Stock has been down all day, about $155 per share. Let's use that as a proxy because if we look back to 2021, which ends the end of January 2022, the fiscal year that's over, earnings were $14.10. So the stock right now is trading at about 11 times last year's earnings. So what do the trends look like for the third quarter? We knew after the second quarter that Target was going to be reporting some pretty weak numbers from a margin perspective. They said that basically they had ordered the wrong kind of inventory. That's something that's likely going to continue throughout this year and maybe into next year. Retail companies don't just order things 6 weeks in advance. They order them months and many months and sometimes a year in advance when you're planning for something like the holiday season. So getting inventory decisions wrong, basically being planned for the pandemic when people were back going out doing things again, was really something that wasn't going to cure itself within a quarter or two. It's going to take a little bit of time. But if the general trends are still going well for Target, I think the company is well positioned. So let's look at it with that framing. Here's the beginning of their release. Comparable sales up 2.7%. That's exactly what we want to see for any kind of retail company. That's on top of 12.7% growth a year ago. So they pulled a lot of business from competitors during the pandemic. It seems like they're keeping that. Comparable sales was driven by a 1.4% increase in traffic, 1.3% increase in ticket size, so maybe a little bit of inflation there, but they also have traffic picking up, which is a positive sign. Here's something that I think is kind of interesting. Comparable sales were up 2.7%, but in-store sales were up 3.2%, while digital sales were up only 0.3%. Digital sales, if you remember, are things like Drive Up, where you order things online, Drive Up, and then they put it in your car for you, or Shipped, or regular digital shipping where they're going to ship it with UPS or something like that. So seems to be that they're keeping a lot of that digital business, and most of the growth is coming from people actually going into the store. Operating margin, this is where you're going to see the decline in profitability. Margin rate was 3.9% for the third quarter, down from 7.8%. Again, shouldn't be a huge surprise because they said last quarter that they had some of those inventory challenges. Right here it says reflect higher markdown rates, inventory shrink, and merchandise and freight costs. So these are things that will eventually normalize over time, but right now they are headwinds for Target. Now let's look at some of the things that they highlighted in their infographics. They saw share gains in apparel, food and beverage, beauty and essentials, home, hardlines. I think this is really telling for where Target is going as a business. I look at this as grocery plus. If you're going to Target to buy groceries, then you're probably going to add some other stuff when you're there. So if they can grow and gain share in the grocery business, that's going to be really positive for the company as an investment long term. They also seem to be doing pretty well with their store-owned brands. Good and Gather is one of those brands. They say that that's a portfolio of $30 billion of owned brands. We can quibble with that number, but the fact that they're growing comparable sales with the brands that they own, I think is a positive. And then management talked about $2 to $3 billion in savings that they could see by reducing complexity and lowering costs while continuing to support our team. If you think about what has happened at Target over the last 3 years, the company was sort of accidentally really well prepared for the pandemic because they had started rolling out things like Drive Up and Shipped. That's a company that they had acquired pre-pandemic. And they were just able to expand those as the pandemic wore on and people started using them more and more, found them to be more and more convenient. It seems like Target's keeping those customers, but there's probably a lot of inefficiency built into the business as they built that out. So that could be $2 to $3 billion in savings. We'll see if they're able to hold to that. But that's not really what interests me in Target right now. I think the thing that we're seeing with Target is investors are expecting a lot from a company like this from an operational standpoint. And the company's just going through some growing pains as it comes out of the pandemic. A lot of this we knew about. This shouldn't be a surprise for investors, but the stock is down nonetheless. If we look at last year's earnings as a proxy, the company is still growing from that base. Margins aren't where they were a year ago, but I think they will be able to get back to where they were last year if they can continue to grow. This is a great value trading at 11 times last year's earnings. That multiple is going to go up because earnings are going down. But I look at this as a value stock and a really well-positioned retailer. We're seeing a lot of e-commerce companies have to pull back. Amazon is laying off people. That could be to the benefit of Target. Target, we found out today, is not laying off employees. So this is a company that I think is really well-positioned and is a really good value for investors. And the Wall Street seems to be selling it off, but I'm a buyer today. This is one I'm going to be adding to my portfolio over the next couple of weeks. What do you think about this one? Is Target a stock that you would add right now at this price? Or are you more interested elsewhere in retail? Leave your comments in the comments section below. Give this video a like and follow Rive Investing. I will be back with more ideas later this week. Thanks, and I'll see you next time.